There's a simple question I get often as a financial planner. In fact, it's the question I get more than any other. I have this much money. I want to spend this much in retirement. Am I going to be okay? Am I going to make it? Can my goal be supported by the money I've worked so hard to save? It's a reasonable question. It makes sense to me. It's the most common question. The problem is most people don't have an easy way to find the answer. So that's exactly what I help clients do. So what I'm going to do in today's video is walk you through how we look at income and portfolio sources and get into retirement to look at goals and determine how are we going to determine if a plan is viable or not viable. So I'm going to show you the analysis that I do with clients just like you at Brightworks Financial Planning. Now, this video is not meant to be personalized financial investment or tax advice. It's just to educate you so that you can retire with confidence. If you're new to the channel, I'm Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner. I love to do these videos to help you retire with confidence. Let's get into today's case. Okay, let's talk about this couple that wants to retire. It's Steve and Susan. They are 60 years old. They are about to retire, and this is where they stand. They have $2.5 million in assets, and that's going to be spread across 401k, a Roth IRA for Susan, a 401k for Susan, and a joint taxable account. So as you can see, they really have three different income sources to pull from in retirement. That will come into play in a second. So that's the first thing we want to talk through. The second thing is, do we have any debt? So when we talk about retirement planning, the first place we want to start is the balance sheet. That's basically what assets do you have versus what are your liabilities. In this case, they don't have liabilities. They have a paid for property which is valued at $500,000. So seems simple enough, but I'm about to show you how having a dedicated process to go through to look at these factors can be very helpful when it comes to retirement planning. Now, Steve and Susan are pretty simple. They don't really have any drastic or extravagant goals. They want to live on $10,000 a month, and they estimate that their Medicare premiums when they get to 65 will be about $5,700 per person. Now, that's going to be a combination of what they might pay in Part B and potentially a supplement, but again, we've got to put some number in for healthcare. The number from 60 to 65 is going to be included in this 10,000 number. So what's going to happen here is over their retirement, that 10,000 is going to inflate, and I'll show you that in a second. So these are the basic facts of our case. Now, in some cases, when I do this with clients, we may want to add in some specific goals, such as travel goals, vacation right here, if they need to buy a new car, if they have a wedding that they have to pay for children that are still unmarried. There's lots of things we can put in here. Legacy, gift, we can put it inheritance. We can put all kinds of things in here. But I want to start simple because I want to show you the different levers and the different angles that I approach this through to give people confidence in their retirement plan. So that's the goal. That's what we want to spend in retirement. But what income sources do we have? Now, for many people, that's going to be a pension, or it could be some other form of delayed compensation, whether it's deferred from a job. But in this case, it's just going to be Social Security. And Steve and Susan have had pretty good working records, so they both are going to have pretty decent Social Security payments. So at full retirement age, and at 67, Steve will get paid $27.50 a month, and Susan will have $27.50 a month. Now, for most people, they're not going to have identical records, just doing this for illustrative purposes. So let's move on from that. So now that we have a net worth, we have goals, we have income, what else do we need to consider? Now, if we were further from retirement, we would be able to plug in savings. And in this case, we'd be able to put all of these in here. So I put these here for reference. And again, these are from a previous case. I'm going to back them out because they're not going to apply to our case. But we could have things like 401k, taxable savings, HSA savings. In this case, this couple doesn't have any of these because they are retiring, so they're not going to be saving. But it is a helpful thing to model when we're looking at retirement planning. So in this case, simple enough. We don't have much. The other thing that can be helpful here is to talk about other expenses that are not listed in the goal section. In our case, we don't have any. So now what I'm going to do is I'm going to look at what their overall probability of success will be. Now, all this means is that we're taking some assumptions about how their investments will perform over the future time period. And we're going to take those and we're going to run that in a Monte Carlo analysis. That's what's happening in the background. And basically this is going to give you a range of outcomes. Now, I'm going to explain in a minute why I think that this number is not as helpful as maybe you've been led to believe. But for now, let's talk about a really important part of retirement, and that's cash flow. So when you're working, it's a foregone conclusion. You get your paycheck and it comes in and you either spend it or save it. Now, when you retire, how that paycheck comes is more in your control. What do I mean by that? So I mentioned before that we have different types of assets that this couple has saved, meaning they don't just have Roth money, they don't just have 401k money, they don't just have a taxable account. So what's helpful here is, especially if we're retiring earlier and we have not decided to do Social Security at retirement, which in their case is age 60, they'd only be able to turn that on at age 62. So at 67, on this very busy slide with numbers, I just want to draw your attention to a couple simple things. So it's as simple as what comes in, that's cash inflows, what goes out, that's outflows. Now, we've already decided on what our expense number is at age 60. So that $120,000 simply represents $10,000 a month. Now, from age 60 to 65, we are including in that number a number for healthcare, which is undetermined, right? Everybody has a different plan for that. Now, notice there's an opportunity here between age 60 and age 67. And that opportunity is around tax planning, because if they are retiring with this amount of assets, the chances are they were making a pretty decent income to get to this point. So what this shows is the order of distribution matters when it comes to taxes. So between age 60 and age 67, most of those withdrawals are coming from that joint taxable account, and they've done a great job saving. This is another reason why it's really helpful to have this type of account in retirement, because if they wanted to, they could decide to convert some of their tax-deferred 401k money from 60 to 67. Now, I'm not modeling that in this case, but I'll show you how I might go about it. And that being said, the tax payments are going to increase once we get to age 67. The reason being is because we have forced income. So now we are taking distributions from which 401ks usually become IRAs at this point. So this would be tax deferred money, and we have to pay taxes on that. So at 67, what I want to draw your attention to, though, is before we move on from this, expenses are not static. That's a good assumption to put in a plan. $120,000 is not going to go as far 7 years from now. So $120,000 is going to inflate. And the other number I want to draw your attention to is on the right. So this number in parentheses represents our portfolio withdrawal. Okay, so we've got to put a baseline assumption of what we'll earn between age 60 and our entire retirement. Now, that could be different for each plan. And in this case, we've made this a moderate return. So what's going to be in our analysis here, I can click on the investment section and show that to you. So basically what we're going to do here is we're modeling a portfolio that is essentially a 50-50 balanced portfolio. That's showing you what's happening. So that's 50% equity and 50% fixed income and cash. Now, what does that actually mean? What it means is for 50-50, we're modeling about a 5.8% return. Now, are they going to earn that return? Likely not. No one knows the exact return we're going to have, but we need to model something realistic. And I'm going to show you that even as we've modeled this, we don't have to get this perfectly right because we have an ability to stress it. So I'm going to go back to our cash flows. I'm just telling you what's running in the background. And what we've done here is this shows how our assets grow or are drawn down over time. So notice we're taking distributions, so our portfolio is staying pretty flat over this first 6 or 7 years because we're having growth, but we're also having distributions. So let me show you what that looks like from a withdrawal perspective, because when it comes to retirement, it's not just how much you spend, but it's how much do you spend as a result of a percentage of your total account value. Okay, and that's called a withdrawal rate. So what actually happens here in this plan? So what this is saying is, even at age 60, we're only taking under 5% out of our total portfolio value, right? So if we just think about the math on this, right, for every $1 million, 4% draw will be 40,000, right? So we've got well over 2 million, that would be 80. We've got 2.5 million. So these numbers make sense intuitively. So getting to those numbers is fine, but notice when we get to 67, we're going to relieve some of the pressure on that portfolio. And that's because Social Security is going to kick in, which helps us. Now, you will notice that when we get to age 75, this will start to linearly increase. The reason is because required minimum distributions kick in this case. But this is not bad. This happens to everyone. So when we're in our late 70s and 80s, we're going to be taking larger withdrawals if we still have tax-deferred accounts. It's a requirement. So in this case, this is what allows us to have a pretty good confidence that we're not running out of money, right? So let's go back to this number, and you go, Forrest, I don't like 84. I was an A student in school. 84 seems like a B to me. I don't like it. Here's why that's not necessarily true. All that really means is that there's a 16% chance along the way that you will have to make some adjustments in your spending, because remember, retirement is not linear and it's not static. We don't need to necessarily model it as such. So it's very unrealistic in most cases that you're going to spend more money every single year between when you retire and the end of your life. For a lot of people, especially for retiring at age 60, you may want to model some expenses that are actually higher in the early years to relate to things like travel, but then you might want to reduce the expenses later. These are all things you can do inside financial planning programming. That's why I really like this as a tool to give clients more data so that they can make better decisions. So speaking of data, there's another really important section here, and it's the stress testing section. So all this is doing is it's showing us common variables that could materially impact our plan and our probability of success, or again, to reword, the probability that we'll have to make a change along the way. Okay, because it doesn't mean that you don't succeed, because really what you want to know is, am I going to outlive my money? That's success. I need to be able to have money as long as I'm living. So in this case, what this is saying is we can model things that would be very concerning for a client entering retirement, such as, what if the market drops precipitously? What if there's a cut in Social Security? That's certainly been in the news. What if inflation's higher than what we modeled here? What if asset returns are lower? All these things are real probabilities. So I moved one of these sliders, I can change it. So what we can identify is which one of these is the largest threat to your plan, right? So market drop and secrets of returns is definitely a threat to this plan, because you can see that the percentage has dropped more, right? But another thing you could think about is this shows you where you may need to have flexibility. So not only can you build hedging around it, meaning what are we going to do in terms of portfolio construction or withdrawals to mitigate this risk, we could also say, oh, by the way, if the market does drop, we should probably be flexible around that number that we've started from the beginning. So this is a great section to model things that might be of concern to you. Another big one is longevity. What if we live longer? So this plan basically says, let's make it go 5 years longer. So instead of 90, let's go to 95. Does that materially impact the plan? And what if inflation happens higher than we expect? These are great things to look at. What if we have to spend more at healthcare? So you get the idea. So this is a place that could really show you, if you're someone that wants to build a plan where you mitigate against all risks, I'll go ahead and tell you it doesn't exist, but you could at least look at this and determine where are the areas that we need to keep an eye on. Because in my opinion, if you stress test your plan and everything is still 99%, the chances are you're really just not living life. You are living way too conservatively. So just because something drops because you model it doesn't necessarily mean that you have to build it up to the point where everything is 99 across the board. In most cases, that is not the right choice. The other thing that we can do here is we can model some different tax strategies. And for most people that are retiring, especially when this couple is retiring, the best thing to model is some form of Roth conversion. So in this calibration section, what we can do here is we can model converting to Roth, and we could look at doing it over different brackets, and we could look at how long we want to do it for. So in this case, conversions may start at retirement age, and conversions might end at 67. So what would it actually look like to fill up certain brackets? And so if we know we're already in the lower bracket because of our taxable distributions, which I already showed you. So from age 60 to 67, there's going to be a low tax bill because we're taking advantage of the 0% capital gains bracket for those taxable account distributions. Well, what if we modeled doing a conversion on that 12% bracket? What would that actually do for our plan, right? So this is showing you doing that conversion. Now in this case, it's not going to do too much, but basically what you're looking at here is when it says more, it's saying what are the tax adjusted ending assets for the strategy. Now, I will make a point here. There are a lot of different ways to look at this. You can look at it through an ordinary income lens. You could look at it through a capital gains bracket lens, meaning how much can we convert so that we stay in the 0% bracket. You can also look at Medicare premiums. Now in this case, they don't want to spend enough to where this would become an issue. So really, this isn't really an IRMA case, but what if that figure was we want to live on $20,000 a month or a higher number? In that case, IRMA is going to be something, and that's income related monthly adjustment amount, which means that you're going to have a higher surcharge on your Medicare Part B premiums because of the income you made 2 years prior. So this is a consideration of how to model Roth conversions, and this is something that I go through with clients. So I just wanted to show it to you. In this case, most of the time I've made videos, I've had a very specific aim of what I'm trying to teach. In this case, I'm just showing you what's possible. I'm showing you that when we look at these things, not only do we look at stress testing and tax strategies, we also look at all the income and expense variables that could change. Now, in addition to income and expense variables, there's all kinds of things that we could add in here that we want to look at to see if it materially changes the plan, right? The biggest one in your mind is probably what do we spend, but there are other things that we can look at, meaning how do we invest, when do we take Social Security, on and on and on. Adding different expenses, adding a long-term care event, all these things can be modeled. And these are all important things for retirees to look at. So if this is something that you're looking to have done, this is exactly what I do at Brightworks Financial Planning for clients. Again, hope you enjoyed this video. It just gives you a little bit of behind the scenes of how to utilize financial planning software to get some peace of mind around your retirement plan. Please comment, subscribe. Love to see what you'd like to have next in terms of the videos that I create. I want them to be educational. I want them to be informational. Again, not specific advice, but hopefully you found this helpful, and I will see you on the next video.